Good morning, and welcome to the Superior Energy Services 4Q19 and full year earnings conference call. All participants will be in listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star then 1 on your telephone keypad. To withdraw your question, please press star then 2. Please note, this event is being recorded. I would now like to turn the conference over to Paul Vincent, VP of Treasury and Investor Relations. Please go ahead.
Good morning, and thank you for joining Superior Energy's fourth quarter 2019 conference call. With me today are Superior's President and CEO, Dave Dunlap, our CFO, Westy Ballard, and our CAO, Jamie Spexar. During this conference call, management may make forward-looking statements regarding future expectations about the company's business, management's plans for the future, operations, or similar matters. The company's actual results could differ materially due to several important factors, including those described in the company's filings with the Securities and Exchange Commission. Management will refer to non-GAAP financial measures during this call. In accordance with Regulation G, the company provides a reconciliation of these measures on its website. With that, I'll turn the call over to Dave Dunlap.
Thank you, Paul. Good morning to everyone listening to our call today. We took a number of significant and positive actions during the fourth quarter, all of which we believe demonstrate our commitment to our shareholders to reduce debt, generate free cash flow, and improve returns on invested capital. The most meaningful of these actions includes a substantial corporate transformation, which we disclosed on December 18th, demonstrating our commitment to adapt our company to the long-term structural changes which have occurred in our industry over the past several years. This transformation largely consists of the combination of several of our U.S. service lines with the complementary service lines of Forbes Energy Services. This new company will be a publicly traded consolidation platform for U.S. completion, production, and water solutions. We anticipate closing in the second quarter. In conjunction with this transaction, we also announced an exchange offer for our $800 million 2021 outstanding senior notes, which we anticipate will expire tomorrow. We believe this will substantially address near-term debt maturity concerns and should allow for the free cash flow and return-oriented nature of Superior Energy to define the value of the company going forward. Additionally, we discontinued our hydraulic fracturing operations and expect to sell the assets of that business over time. We took this measure after concluding that operating this business was not supportive of our long-term objectives and after being unsuccessful in finding a buyer of this business as a going concern. We expect to use any proceeds from the sale of pressure pumping equipment to help us further reduce our outstanding debt over time. We also announced a 1-for-10 reverse stock split on December 18th, following a special shareholder meeting and vote. Shortly thereafter, our common stock resumed trading on the New York Stock Exchange under the historically familiar SPN ticker symbol. Our efforts to relist on the exchange were not symbolic, and we believe that meaningful equity upside exists within our stock. From the market close on December 17th, 2019, immediately before we began announcing these actions, through the market close of February 19th of this year, Superior Energy stock is up more than 40%. We believe that steps we have taken to address investor concerns create opportunities for further upside. Clearly, most of what we announced during the fourth quarter evolved over time, and I will spend a few minutes on how we got there. When the industry downturn began late in 2014, we aggressively reduced costs and altered our operations with a goal of maintaining competitiveness should the downturn be short-lived, as many in our industry did. We also conducted a longer-term assessment of the market and determined that as the massive growth experienced during the prior decade seemed unlikely to return, more substantive actions may be required. What was also clear was that the investment community was no longer rewarding a strategy of product line and geographic diversification, a strategy that had served us so well in the past. We evaluated numerous ways in which we could effect a transaction that would effectively separate our U.S. service businesses and our global cornerstone franchises, creating two distinct investable platforms in the process. As this evaluation progressed to a point at which we were considering taking action, the U.S. land market staged an approximate 8-quarter recovery, which began in the second half of 2016. We refrained from taking definitive action during this brief recovery, but continued to prepare internally for what we knew would ultimately be a separation of our service-driven businesses from our global businesses. These preparations included a series of internal cost reduction exercises along the lines of the most recent combination of our well service and fluid management business that we disclosed with our third quarter results. During this time, it also became evident that the hydraulic fracturing market was going to be oversupplied for quite some time, and that the competitive landscape would make long-term investment in that business challenging for us. In the fourth quarter, we completed our operations and exited the pressure pumping business. Our remaining non-frac U.S. land service business is an efficient, multi-basin operational platform with limited capital needs, which will only be enhanced by the combination with Forbes. Approximately half of the revenue of the combined new company will derive from production-related activity, which we expect will be less volatile over time than drilling and completion-related services. Historically, these businesses have demonstrated strong free cash flow conversion rates, and once combined, the new company, which I will lead as CEO, is expected to generate free cash flow. This company will operate with a very low capital intensity level and a small corporate footprint. Its primary strategy will be to acquire other U.S. land non-fracturing service businesses, capturing meaningful earnings uplift through cost rationalization and synergies. We do not expect to deploy any growth capital into this business and believe this company will consistently produce cash and reduce debt. Services such as these, by nature, are about people. We believe that our talent development and training have caused execution in the field as well as safety performance to be best in class. Given the safety, environmental, and execution standards of our clients, we have continually found ways to develop a workforce that delivers day in and day out for the most demanding customers in North America. We are excited about the path we are taking, but we have just begun and have considerable amount of work ahead of us. Our next milestone is the expected closing of the combination of Superior Energy's U.S. production and completion service lines with Forbes in the second quarter of this year. As a result of the aforementioned, Superior Energy will be a unique company moving forward. First and foremost, Superior will have a lower debt level with multiple levers to pull to continue to reduce debt over time, leaving the company's balance sheet improved and on stronger footing going forward. The company will be primarily composed of Workstrings International, a premium drill pipe, high-spec tubular and accessory rental business; Stabledrill, a bottom hole assembly, rental, design, engineering, and manufacturing business; Wild Well Control, a well control engineering, risk management, and training solutions business; ISS, a global hydraulic workover and snubbing business; and Superior Completion Services, a sand control and completion tool manufacturing business with exceptional levels of engineering and technical expertise. Competitively, there are high barriers to entry in these businesses. They have strong market share. They all address the most challenging wells and reservoir conditions around the world, and they all require significant levels of engineering and technical expertise to execute effectively. Said differently, these businesses are the exact opposite of commoditized services. Greater than 70% of Superior's revenue will be from the Gulf of Mexico and international markets. These markets have consistently improved over the past several years, and we expect that trend to continue. Superior's global cornerstone franchises are largely asset-driven and can effectively transfer assets to meet demand globally through distribution channels that have been established over many years. Growth capital is generally associated with increased market demand and historically generates strong returns. These cornerstone franchises have consistently generated free cash flow through the cycle, and we feel confident this will be the case going forward. There are also further operational and cost rationalization opportunities, which I know are a priority of our incoming CEO, Westy Ballard. Additionally, after the divestiture of lower margin service lines, the hurdle for capital allocation will only move higher, and it should be clear after the shutdown of our pressure pumping business that we will take all actions necessary to reduce debt, generate free cash flow, and improve returns on invested capital. It is exciting to be highlighting definitive steps that we are taking to demonstrate our alignment with and our accountability to shareholders. We believe both companies that will exist after these transactions close can be successful in generating free cash flow and producing competitive returns in the market as it is today. This should ultimately lead to improved share price and wealth creation for our shareholders. With that, Westy will discuss our fourth quarter operational and financial results.
Thank you, Dave. In discussing our operating segments, all adjusted fourth quarter sequential comparisons are made to our adjusted third quarter results and exclude discontinued operations. For the fourth quarter of 2019, Superior Energy generated revenue of $336 million, adjusted EBITDA of $53 million, and an adjusted net loss from operations of $2 million, or 11 cents per share. U.S. land revenue decreased 15%, primarily due to lower rig count and drilling activity during the quarter. U.S. offshore revenue was flat, as some expected completion tool activity shifted into 2020, and international revenue increased slightly, continuing a trend of methodical improvements in global offshore markets. We concluded the quarter with $273 million in cash, an increase of $13 million from the third quarter, and a 72% increase from year-end 2018. Capital expenditures of $35 million for the quarter resulted in full-year CapEx of $140 million, which was at the low end of our expected range. Cash flow was slightly negative for the quarter due to several factors. Operationally, results were slightly lower as the U.S. land rig count declined. There were also cash costs associated with the discontinuation of our hydraulic fracturing business, as well as the transaction-related costs. We also deployed a bit more capital towards premium drill pipe than was expected due to the continued opportunities we are seeing in international deepwater and the Gulf of Mexico. Given the historical returns generated by our premium drill pipe business, we generally do not hesitate to fund these incremental opportunities. Capital expenditures for the company were 37% lower in 2019 than 2018, and we expect that trend to continue in 2020, with initial capital expectations of $70 to $80 million for Superior Energy and $20 to $25 million of CapEx for the newly combined company. Moving to our segment results, our drilling products and services total segment revenue decreased to $99 million. Premium drill pipe revenue decreased primarily because of a lower U.S. land rig count. Looking ahead, premium drill pipe and bottom hole assemblies, as Dave mentioned, will remain with Superior, and our accommodations business will become part of the newly formed company. In our onshore completion and workover services segment, revenue decreased 11% to $68 million. As noted, we have discontinued our hydraulic fracturing service operations during the fourth quarter. Historically, hydraulic fracturing financial results were included in this segment and are now reflected in discontinued operations for the fourth quarter of 2019. All of the remaining service lines in this segment will become part of the new company that Dave will lead. Our production services total segment revenue of $101 million increased slightly. Increased hydraulic workover and snubbing activity and the startup of cementing operations in Kuwait offset lower coiled tubing activity in the U.S. land markets. Hydraulic workover and snubbing and our international services will remain with Superior Energy. All other U.S. elements of this segment will move to the new company. In the Technical Solutions segment, total revenue declined slightly to $69 million. U.S. offshore completion activity continued at a steady pace despite some expected completion tool sales moving to 2020 from Q4 19. This segment is comprised of our completion tools and well control businesses, both of which will remain with Superior in the future. Before turning the call back to Dave, here are a few modeling related items. For modeling purposes, we assume that the transactions we have discussed this morning will not close during the first quarter. G&A for the quarter was $65 million, and we expect first quarter G&A to fall between $65 and $70 million. We expect DD&A will be between $40 and $45 million. First quarter interest expense will be approximately $25 million. Thank you, and I'll now turn the call back over to Dave for closing comments.
Thanks, Westy. As it relates to our outlook, it may come as no surprise that we anticipate U.S. land markets to be lower this year than last. Our customers are increasingly demonstrating spending discipline, and we expect that to continue. U.S. offshore markets should garner more attention, but will likely remain unchanged in 2020. Internationally, continuing the trend of the past several years of expansion, we expect these markets to continue to improve. Against the backdrop of this outlook of limited revenue growth opportunity, we will continue to look for ways to lower our costs and improve earnings. The actions we are taking and discussing today are to the benefit of Superior Energy's shareholders. We believe that the creation of two investable public companies allows Superior shareholders to benefit from the execution of two very different strategies that would be very difficult to conduct as a diversified company. The U.S. land market is overwhelmed with too many small companies with inefficient cost structures and a lack of multi-basin commercial capabilities. Our newly formed U.S. land company will acquire businesses that do not have the scale, cash, or liquidity to execute a full cycle strategy. We will also realize cost and synergy benefits through these acquisitions that will be accretive to earnings. In a similar fashion to how the industry achieved success before the shale era, we will manage our long-lived assets with very low capital deployment through the cycle. In times of market growth, we will realize better pricing, margins, and returns, but we will not invest in new equipment. When the market retreats, we will scale down using in-house manufacturing, inspection, and repair capabilities to keep appropriate levels of equipment in the field with a minimal capital footprint. This is a blueprint for success in today's market. This is a blueprint for a company that will consistently generate free cash flow. Superior Energy will now be a company levered to U.S. offshore and global deepwater markets with high margin, long life, asset-driven businesses. These cornerstone franchises enjoy competitive moats and barriers to entry, which allow them to make long-term investment in customer relationships and develop unique solutions for some of the most challenging oil and gas projects around the world. With very well-defined capital needs and a profitability profile that should result in consistent free cash flow, Superior will continue to reduce debt over time, expand the capabilities and footprint of these existing franchises, and ultimately add businesses to its portfolio with similar industrial qualities. Before addressing Q&A, I would like to discuss leadership for a moment. Throughout my tenure as CEO, I have continually been impressed by the organizational leadership and commitment demonstrated at all levels of the company, especially during the downturn. There have been periods of extreme stress over the past 5 years, and our leadership team has been decisive and consistent with its decision making. And we have not compromised our commitment to customers who faced a whole host of challenges themselves. Additionally, I'm thankful for our leaders who are responsible for consistently improving our safety performance and raising the bar for safety standards at Superior Energy. In addition to protecting each other and the environment, you are helping us control our costs and attract talented people to work here. As we move into the next phase of Superior's history, Westy Ballard, as fine a leader as I know, along with an exceptional leadership team and board of directors, will navigate the company through whatever lies ahead with a commitment to increasing shareholder wealth and remaining committed to our core values. That concludes our prepared remarks. We'll now ask the operator to open the line for any questions.
Thank you. We will now begin the question and answer session. To ask a question, you may press star then one on your touch-tone phone. If you're using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star then two. At this time, we will pause momentarily to assemble our roster. And the first question will come from Blake Gendroy with Wolfe. Please go ahead.
Thanks. Good morning. My first question is for Dave on the U.S. onshore business. It's one that we don't dig a whole lot into on the completion and workover side. 50% production, levered revenue moving forward. I was wondering, just in the context of what we see now as severe capital starvation in the U.S. land market, maybe the inability for these assets to move around, even if they do kind of outlive the depreciable life. I was wondering if you could speak to maybe the diversification at the basin level, and then some of the other dynamics going on, particularly as your customers are moving from a drilling and completion growth mentality now to a EUR and sort of monitoring production over the life as they approach U.S. shale. Thanks.
Yeah, sure. I mean, I think that in this business today, you have to allow your assets and people to be mobile from one basin to the next. And what we have witnessed over the past few years are changes in activity levels from basin to basin. And so, part of our advantage is having exposure in all of those basins in the U.S., including in production completion market in the Gulf of Mexico. And being able to move those assets and people around as our customers' spending patterns in each of the basins change. I think the other thing that's been a common part of our operating philosophy in recent years in the U.S. land market is that when we see service lines in particular basins where, from a competitive standpoint, we cannot attain a price or effective utilization levels to consistently and reliably generate margin, then we stop operating those service lines in those basins. And you've seen our revenue decline in production and completion services over the course of the last several years, and in many cases, revenue declines have not been associated with huge margin declines. And that's a result of being careful and cautious about the markets that we're willing to operate service lines in when pricing and competitive tension prevents us from making a margin. We'd rather stack the assets than to operate them at the risk of losing money. And that's been a disciplined approach that we've taken for some time now, and it's produced a good result, and I think it will be the same disciplined approach we take going forward.
Got it. That's fair. We also notice the assets held for sale now on the balance sheet. We know and can make as best a determination as we can as to what or how much of that is pressure pumping. I was wondering if you could comment on what else is in that bucket, and maybe if there was any visibility into the non-pumping assets that are held for sale. What kind of timeline are we looking at? Because that could be another positive catalyst for the shares as well.
Yeah, sure. So, I mean, just to be clear, the assets that are in that category of held for sale are all assets that came from the pressure pumping business, and it's a wide range of assets, but most of them are related to fracturing. So fracturing trailers and blenders, there's pickup trucks and tractors and accessory equipment that goes along with fracturing, but all of those assets came from the fracturing business. We've been very clear in describing what we believe to be a period of time that it will take to divest of those assets. And I can tell you, this effort to divest of those assets really began very late in 2019. We're still in what I would describe very early stages of understanding what market opportunity exists there. It's a process that I think you will see us continue for at least through the remainder of 2020 and probably into 2021. We're not conducting a fire sale. We believe that those assets still have significant useful life, and that they will find a place with existing fracturing companies as more and more attrition of equipment takes place during the course of 2020. So I look for us to report on a quarterly basis on results of sale of those assets, but I would not expect them to be cleared off of that category of assets held for sale in the first half of the year. We'll see some that move, and we'll keep you guys up to speed on what we accomplish there.
Understood. And one final housekeeping follow-up, if I can. The G&A and D&A run rate post-close, you gave us a good idea for the first quarter, but I was just wondering if you could comment on that once this deal closes. And I was also wondering if you could give us the cash cost for the pumping business in the fourth quarter, just so we can kind of back into a free cash flow number. That would be helpful. Thanks.
Yeah, why don't you get with Paul after the call, and he could talk you through cash cost on pumping. I can tell you that when we report first quarter earnings, we will offer some guidance on what cost structure in general and your modeling assumptions should be for Superior going forward. But I don't think we're prepared to do that at this point.
Okay, great. That's helpful. Thanks for the time, guys.
You're welcome.
The next question comes from Kurt Hallead with RBC. Please go ahead.
Hey, good morning.
Hey, Kurt.
Hey, exciting times on this split, so kudos for working your way through a very difficult time. That's to everybody on your team, Dave.
Yeah, thank you.
It's been a tough run. So, Dave, you emphasized that both these businesses on a go-forward basis will be kind of consistently free cash flow positive on a through cycle type of dynamic. A lot of conversations now with investors are kind of focused on a free cash flow yield type of valuation, or at least forecast. What kind of, when you think about the through cycle free cash flow generation of both these companies, have you given it any thought in terms of what that yield could be?
Yeah, to answer your question, I don't know that we have thought about it or targeted it as a specific yield, Kurt. I mean, I think that one of our biggest challenges in being a consistent generator of free cash flow in recent years has been with a result of the hydraulic fracturing business, and I think exiting that business puts us in a much more predictable position from a free cash flow generation standpoint. Part of what makes the U.S. service businesses that will be part of the new company predictable from a free cash standpoint is the very low capital spending nature that should exist in those businesses. And those businesses have not attracted capital from us in any significant way in recent years. The assets are long life assets. There's an abundance of them that exist in the market and quite frankly in our idle yards today. And so we really see capital spending in those business lines being very, very low for quite some time, which is what gains us confidence in the free cash flow. So I don't know that we've targeted a specific yield, but more than anything else, we have targeted consistent free cash flow generation.
Okay, great. Appreciate that color. And with respect to the company that you're going to lead, Dave, you talked element of fragmentation and the opportunity to consolidate. Just wondering if you can kind of give us some general sense as to what the first areas of opportunity could be for consolidation.
Yeah, I appreciate the question. I've certainly had a lot of conversations with potential participants since we announced this separation of the company on December 18th. I think that what will be most interesting to the new company are businesses that are in the same product line. So we're not necessarily interested in expanding into new and different areas outside of well service rigs, coiled tubing, fluid management, flowback, cased hole wireline, plug and abandonment, those kind of basic service lines that we have. I think that I like the mix that is 50% production related. Not every target out there will be of that nature, but the benefit there is that production related revenue is going to be a bit stickier. It's LOE based as opposed to drilling completion capital spending based. So those service lines in those areas will be most interesting. I think the other thing is that, we exist today in all of the basins, so there's not a particular target out there that would be basin specific that would be of particular interest. Look, we're going to look for candidates that are additive to our balance sheet with assets that are of good quality and that provide very predictable accretive earnings. And there are lots of candidates out there.
Okay. And maybe if I just take that up, give us a reminder of what your targeted leverage ratios would be for both companies.
Yeah, so if you read through our prospectus, starting with RemainCo, it's kind of a 4.5 to 4.7 leverage ratio at close, and then on the NewCo, it's a 2.5 to 2.7.
Okay, thanks for that. Appreciate it.
Yep.
The next question will come from John Daniel with Simmons. Please go ahead.
Hey, Dave. I got just two questions for you. The first is a follow-up to Blake's, but with respect to the PUMCO assets, have any of the fleets been sold in Q1?
We'll report to you on results of any Q1 sales when we report first quarter earnings.
Okay. How about this? As people are looking at the assets, is it your sense that it's people looking to buy replacement capacity, or have you seen any people who are sort of speculators trying to find an opportunity?
Yeah, I think at this point, most of our conversations have been with people that are on the strategic side of the business. So, think existing companies or those that are in the equipment business. I don't know but listen, we've had some people that have come that have looked at equipment that are from outside of the U.S. market. So, I think there's a wide range of interest. I'm not sure we've seen any that are pure speculators, John.
Okay. And then a follow-up to Kurt's question on the NewCo. As you look at the consolidation out there, the opportunities, do you see yourself being more, basin focused on your consolidation strategy or service line focused on the consolidation strategy?
I don't mean to be flip with the answer, but I think it's earnings focused.
Okay.
One of the big benefits that we see with the combination with Forbes is the synergy and cost saving that we're able to generate. And on a trailing 12-month basis from September 2019, I think we pointed to close to 30% earnings improvement just as a result of capturing consolidation cost savings benefits. So, I think that those targets that are going to be most attractive are those that we see the greatest opportunity to create consolidation cost savings. And, if you think about a market environment that we believe does not offer any real upside in the U.S. market in the coming years, the way you create earnings growth is through capturing consolidation cost saving benefits. So those targets that give us the greatest opportunity to do that come with good assets, will probably be our priority.
Okay, fair enough. Thanks, Dave.
You bet.
And our next question is from Daniel Burke with Johnson Rice. Please go ahead.
Yeah, good morning, guys.
Hi, Daniel.
Hey, Daniel.
Dave, NewCo's been a popular subject here in Q&A, and actually had one more for you. I guess our view on consolidation in the U.S. onshore market has been that debt levels have made it difficult for some combinations to occur, and kudos to making the move with Forbes. But what's your perspective on the ease at which a levered NewCo will be able to find appealing combination opportunities with other peers who might also carry leverage or might not?
Yeah, I think it's a reasonable question. I think that clearly we will be interested in those companies that don't come with much leverage. We would prefer to have acquisitions, mergers that are deleveraging in nature as opposed to adding to leverage. I think that what we will look for are those companies that have investors that are looking to be part of a larger platform, and so it's a function of, you think about owning a piece of something or owning something today that is very small, that does not offer any near-term liquidity options. Would you rather stay in that vehicle, or would you rather fold into something that's going to be larger that ultimately does offer a better pathway to liquidity? But to the question of leverage, clearly any company in these businesses needs to continue to look for ways to delever, and we will continue to do that with the new company, and Superior will continue to do that with what Westy will be running.
Okay, great. I appreciate that answer. And then maybe one on production services, and I recognize, of course, that business, like most of the other segments, is going to be to some extent cracked in two. But the EBITDA level in production services was a little lighter than we thought in Q4, particularly in the context of a nice step up in international. And I didn't know if it was possible to get a sort of baseline expectation for maybe how Q1 looks in production services, since there may have been some moving pieces in the fourth quarter.
Yeah, listen, the biggest, there have been a couple moving pieces. One, of course, was the reduced U.S. land, particularly coiled tubing activity that we had in the fourth quarter, and that was strictly a result of less completions-related work. But the other thing that we've had going on, John, is the scale-up of our cementing contract in Kuwait, which really began during the fourth quarter, and I would tell you it was a loss during the fourth quarter. We don't expect to be fully up to a revenue run rate on that Kuwait cementing contract until probably the second quarter or sometime mid 2020. So it'll continue to have some distortion in the overall results in production services. We're really excited about this Kuwait contract in that it is long-term, 5 years. It is our first permanent service contract in Kuwait, where we've done some well control work in the past and have had some other kind of one-off projects, but this is the first time that we generate a really solid, steady stream of revenue. We won't be fully up to scale from a revenue run rate and margin performance there until probably mid-year 2020.
Okay, got it. All right, guys, I'll leave it there. Thanks for the time.
Thank you.
Ladies and gentlemen, this concludes our question and answer session. I would like to turn the conference back over to Dave Dunlap for any closing remarks.
Well, thank you. We appreciate all of you being on the call today, and we'll look forward to speaking to you again. Thank you.
Thank you, sir. The conference has now concluded. Thank you for attending today's presentation. You may now disconnect.
Thank you.